Okay, let's go ahead and open our 19.1 work together, which is for our buying of plant assets as well as paying some property taxes. So we have 4 transactions here happening in January, February, and July of the current year. Notice that we also have our chart of accounts, which we may need to try to determine what plant asset accounts these are going into. Notice that the only plant assets we have are an office equipment and a store equipment. So let's go down and look at our directions here. It says that we need to, oh, of course it's not, is it going to make it? Let's put this back here so we can read our directions. We need to journalize the given transactions for O'Donnell Copy Center for the current year on page 1 of the cash payments journal. And then just remember that we don't need to enter a C for the check because that's the only way that we can pay for things that already has that in our post reference or in our source document number. So we have our cash payments journal here as well as our transactions. So let's look at number 1. It says on January 3rd, we paid cash for a copy machine for use in the store for $800. So let's go down here to our cash payments and we'll put in January 3rd. And since it says it's for use in the store, we can go ahead and, well, we would know then that that would be store equipment is going to be our account title, the plant asset store equipment. And our check number was 241. And we bought that chair for $800, so we're going to have a general debit of $800, and then we're also going to have a cash credit of $800. Okay? Then it says on January 5th, we paid cash for an office chair. So since this is going to be used in the office, this is going to be office equipment for that plant asset. Our check number is going to be 244. And $500 general debit, and $500 for the cash credit. So far, pretty simple. Now let's look at February 26th. It says we need to pay property taxes on our real property, which remember is a land or building, with an assessed value of $200,000. The tax rate in the city where the property is located is 2% of the assessed value. So remember that when you're calculating property taxes, it's always based off of the assessed value, not how much you paid for that property. So we come down here and remember it is in February, so we need to update our month. So we put in February 26th. And then the name going in the account title is property tax expense. And our check number is 268. And then we need to do a little math to figure out our assessed value. So we would take 200,000 and multiply it by 2%, and we're going to get a total of $4,000. So that will be what needs to go in our general debit and then our cash credit. Okay, our last one says that on July 2nd, we paid cash for a filing cabinet, which is office equipment, and a paper cutter for the store for a total of $600. The filing cabinet has an estimated value of $300, and the paper cutter has an estimated value of $450. So this is one of those transactions where we need to allocate a set amount because it does not tell us. We just happen to buy both of these together for $600. We didn't have a specific price for each one. So instead we have to use their estimated values. So we're going to come down into here and we'll put in July 2nd. And then this again is where we have to follow those 3 steps. So in your PowerPoint, it starts on slide number 7. And we have to do step 1, which is to figure out our total estimated value of all of our assets bought together. So I did this on a separate Word document here so you can see. Remember that we bought them for $600, but it said that our file cabinet estimated value was $300 and our paper cutter estimated value was $450. So our total estimated value for those two assets is $750. So then it says in step 2, we have to calculate the cost assigned to each asset. So we take our estimated value of asset number 1 and divide by the total estimated value of all of our assets bought together. And that will give us our percentage of total estimated value. Then we're going to take that value that we just found and multiply it by our total purchase price in order to get our allocated cost. So the first one that we had was that file cabinet. The file cabinet's estimated value was $300. Our total estimated value is $750. When we divide that, we get 40% of estimated value. We then take that 40% times our assets bought, the total that we bought the two assets for, which is $600, and we get an allocated value for the file cabinet of $240. Okay. So let's go back to our Applia and put in office equipment, check number 331. And that we just said our file cabinet had an allocated value of $240. Now let's go back and look at our allocation for the paper cutter. So our paper cutter's estimated value is $450. Again, our total estimated value for the two assets is $750. When we divide that, we get a percentage of 60%. We then take that 60% times the total that we bought the assets for, which was $600. And when we do that, we get an allocated value for the paper cutter of $360. So then we go back to our Applia and we put in store equipment and 360. And then the total of these two together obviously has to be a credit to cash, which if you remember, we paid $600 for the two assets right here. When we add those two together, 240 and 360, we wind up with the 600. So that's the whole process that we have to do in order to be able to allocate between that $600, because it's estimated that it's the file cabinet is worth $300 and the paper cutter is worth $450, but we know that that equals $750, and that's not what we paid for it. So we have to do that allocation in order to properly allocate a purchase price so that we can eventually do depreciation on these assets. So that is our 19.1 work together. Go ahead and do 19.1 on your own and see how that goes.